G'day everyone, welcome back to Pete's Investing and Trading channel. Today we are trading the CCI14 strategy with the average down approach and compared against the Stochastic 14 period breakout and see which strategy is more efficient to trade. Stay tuned until the end of the video where I cover some of my investing rules for safer trading. Don't forget to review our playlists which cover trading strategies, share price and indices reviews, and this video will be covered in the strategies playlist. The strategies playlist is where we cover the simple trading strategy, the average down process and some money management ideas. First of all, some legal stuff. We're not offering financial advice, but rather this is an educational series to help you make better trading decisions. So let's get started. I'm about to demonstrate the entry and exit strategy with two scenarios. The first scenario is where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit when the closing price gains at least 5% gain, take your profits and wait for another trade using the entry rule. We average down when the close of the day declines by at least 5% and the CCI14 breaks above the zero line again. We then buy double the quantity of shares from the previous trade we made. Note we don't use stop losses. Again, watch until the end of the video to review the trading rules. The second strategy demonstrates an entry when the Stochastic 14 period crosses over the 30 line. Exit when the price gains at least 5%. Don't be greedy, take your profits and look for another trade using the entry rule. We average down when the share price drops by at least 5% and the Stochastic 14 period crosses over the 30 line again. Note the Stochastic indicator is standard in most charting software trading platforms. I try to use very basic entry and exit techniques so you don't have to develop or follow any complex strategies. I track the share prices for the following companies since since January 2021. I've done this so I can't be accused of cherry picking stocks which only do well. Some of these stocks have performed well, others have drifted sideways and others have declined. But as you will see, they all return positive results as far as revenue goes. I'll just show you some charts now. And first of all, I want to show you explain what I'm demonstrating in each of these charts. Now, what I really want you to focus on, this is the price chart. This is for the Commonwealth Bank of Australia on a daily time frame. This is the price chart. Now, as I go through each of these various companies, I want you to notice the pattern of these price charts. So as you can see here, the CBA back since the start of 2007 had a decline during the GFC. Then it went sideways for a couple of years, had a nice little gain there over those few years. Bit of a decline during those last few years there, then a drop off during the COVID crisis, and more recently, the Ukraine crisis. These two profitability charts at the top are the profitability for our two strategies, and I'll cover those in a bit more detail. I'll zoom in, and that's what I've done here. So this one here is our CCI14 strategy, and this one up here is the Stochastic 14 strategy. And these indicators down here are the CCI14 indicator and a Stochastic indicator. So if I drill down on those and go through a bit more detail. So as you can see here, we've got the two strategies. These bars represent where the entry was made and where the exit was made of the trade. So let's first of all talk about the CCI14, the blue one here. So the CCI14, you can see here, breaks up. This is the CCI14, and the red line there is the zero line. So we only buy when the CCI14 breaks above the zero. So that indicator there indicates we bought. You can see there, we bought 20 shares of the CBA when it broke above the zero line. Now what I've done here, I've drawn a little tool, a little ruler, which shows a 5% or just over 5% gain. So you can see there, we're closed out. It just managed to be in between the 5%, so we didn't close out. We ended up closing out here of that CCI14. So you can see the price went up, went down, went against us. We still stayed in the trade. Went up and down, a bit of a roller coaster event, but we finally closed out there. You can see there, when it closed above the 5% period, 5% gain was made, and we closed out the trade for those CCI14. Also, for the Stochastic 14 trade, we enter the trade, as you can see here, on the red chart up here. The Stochastic 14 breaks above the 30 line, and we enter our first number of shares. We enter also 20 shares there. Now this is a quicker trade We closed out again when the 5% gain is made, and it just happened to close out there above that point there in the stochastic period, and we closed out the trade there. We enter another stochastic 14 trade there, and it closed out again when the 5% gain was made. Now, you might ask, well, why didn't the CCI14 close out there? Well, it just probably in that particular trade, we missed that little by probably just a few points, a few cents in terms of the price, whereas the stochastic did make that change, and we closed it out for the 5% gain. So that's entering one lot of shares for each of those two. If we drill down on this particular period, you'll see here again the CCI14 breaks above 0. We enter one lot of shares there. The price goes against us, but notice here I've drawn another ruler. It's dropped by more than 5%. But we don't enter another lot of shares for the CCI14 until the CCI14 breaks above 0, which is done here. So we enter another lot of shares, as you can see there. So now we've got 80 shares total. We started off by having, again, we're buying $2,000 lots. We bought 26 shares. So whatever the $2,000 lots can buy us, that's what we buy. The price goes against us, we buy another lot of shares. Now we've got a total of 80 shares there. Now we close out the CCI14 when we've gained at least 5% from our average price. So notice, because we bought shares there and bought shares there, the average price will be now somewhere in the middle there. So that breaks above 5%, so we close out our trade for the CCI14 there. The stochastic 14 likewise breaks above the 30. We buy our first lot of shares there, which is 27 shares. We keep going. Now notice if I move that ruler to that point there, the 5% loss wasn't achieved, and we still were in a trade here, and it wasn't achieved until that point there. It's less than 5% or greater than 5% loss, so we enter another lot of shares there. Again, it averages down, very similar to the CCI14, and we close out on the same day for the stochastic 14, just coincidentally on the same day. Now, if you drill out, look at the total, you can see there the number of trades made along the period. But as you can see here for the stochastic, the total revenue generated over those years was 40,974, whereas the total revenue generated for the CCI14 was 14,578. Now, I'll cover the table of results for all these charts at the end of these, as I show these charts. Let me quickly show you the other charts, and again, I want you to focus on the price chart, and I'm not going to drill down on the scenarios of the close and entry of these, the entry and close of those positions. I simply want to just show you the price movements and see how it performs for all of these. Next, I want to show you BHP. So again, just demonstrating how it performs. Again, a much wilder ride in terms of up and down of the price chart. You'll notice there have been a lot more average downs for both of the strategies gained. And again, I'll go through the results, the profitability results in a later table. I'll go through these fairly quickly so I don't bore you too much. Volkswagen. Again, a big spike back here in the start of 2008, but a very big drop off as well. But otherwise a pretty flat performance for the share price. Again, demonstrating the share price movement and how the profitability is affected. Telefonica in Europe. This is more of a declining stock. As you can see here, some ups, but usually on a sideways, and then more recently in the last few years, a declining performance. You can see there a lot more averaging down happening in the last couple of years. Look at JP Morgan. This has been a nice appreciating of the share price. Again, most of the averaging down has occurred back here during 2011-2012 period. Johnson & Johnson. Another nice appreciative price chart. Again, most of the downward averaging down happened during the GFC. There was some downturn during COVID, but you can see they're very minimal compared to the GFC period. And lastly, to show you Caterpillar. A pretty good price chart movement more recently, fairly flat during those early years. During the GFC especially, had a bit of a downturn during the 2015 period. Again, a nice appreciation of price during a bit of a downturn during COVID, but very hard appreciation during the 2020-2021 period. And then more recently during the 22 and Ukraine crisis. Now let me show you very quickly the table of results. Now this is the CCI14 breakout strategy. Note we're trading $2,000 lots per trade, and beginning back in back testing. We started all this back in January 2007, which covers the GFC, COVID, and the Ukraine downturn. We show total revenue per stock, the number of times we had to average down, the total drawdown effect, then a monthly average revenue based on the number of months from 2007 until today, showing a monthly return. I'll let you pause the video and just digest those numbers for the CCI returns. But next, I want to show you the, and these are results for the backtesting the stochastic approach with a 5% gain to exit to trade and then decline of 5% to average down. Again, pause the video to digest those numbers. But then here I've got a table that summarizes the two backtested results. Note the revenue generated by each, but especially the drawdown required. The profit over drawdown percentage is our key indicator for efficiency. The stochastic strategy has a better profit over drawdown result, but note the higher drawdown required had you traded those 7 stocks, which would also have yielded a much higher revenue return. Note every price chart is unique like a fingerprint and behaves in its own way. Depending on what instruments you trade and how disciplined you are, you'll get varied results. So now I'll cover some of my trading investing rules. So today we covered a couple of simple trading strategies with a better probability of price increasing from our entry point. There are many videos which show you how to enter a trade, but most of them don't clearly explain when to exit the trade profitably. In this video, we showed you an effective way of exiting the trade profitably. Note also we don't use stop losses. That's a sure way of minimizing returns and more often than not, losing money from your trading account. Instead of stop losses, we use the average down strategy with some disciplined money management. We show you how to effectively average down and ultimately close out the trade profitably. This approach has been back-tested on stocks, CFD indices, commodities, and forex currencies. Again, the key here is good money management approach, especially in trading in leveraged instruments such as CFDs. Today we traded, that is buying stocks outright with your own funds and not leveraging off borrowed money. We show the calculated funds required when following the drawdown approach. We go back to the start of 2007 to backtest the shares covered in this video to show the effects of the GFC during 2008, 2009, and more recently the COVID-Ukraine conflict downturns. On average, we show the returns that would have been generated had you traded $2,000 lots per trade, which is factored in brokerage. These returns do not show the returns of dividends, so any dividend payouts would have been added as extra bonus revenue on top of the traded returns. Some of my investing rules: buy proven blue chip stocks only, avoid speculative stocks. This ensures the probability of the shares of the company you are buying has had a good track record and more likely potential of future growth. Buy stocks which pay dividends. Do a quick search of the stock before buying to ensure it recently paid a dividend or about to. This is a good indicator that the company has future potential of growth. If the company recently, that is 6 to 12 months ago, stopped paying dividends, it may be a sign that their growth potential may be challenged for various reasons. Don't short positions, go long only. Even though a strategy can be applied to CFDs and shorting and other leveraged instruments, in this video we only trade in shares we bought with our own funds. That is, avoid borrowing or leveraging funds to minimize risk. Also, if you short a position which pays a dividend, you'll end up paying that dividend to someone else who went long on the same instrument. Do not trade on news. Price is already factored in the share price. If you read an article in the finance pages which talks about an event on the stock you are considering, the chances are it has already been factored in the share price, so you've missed the boat. I did a video in September 21 titled Uranium Stock Too Late to Trade, which demonstrates the effect that news has or hasn't and the share price action. Suggest you watch that video as well. Thanks for watching. Don't forget to click the subscribe button, the notification bell and like button, and get all the updates to the channel. Happy investing and see you in the next video.